Hi, I'm Tim Phillips at Phillips and Company Advisors. Everything we do is built around one idea, helping you build not just wealth, but confidence, clarity, and long-term financial strength. Because the truth is, success with money isn't about spreadsheets alone. It's about behavior, patience, and perspective. That's why I'm excited to introduce our friend Morgan Housel, best-selling author of Psychology of Money. Morgan is one of the most thoughtful voices in finance. He brings stories, history, and human behavior together in a way that makes complicated ideas simple and powerful. Morgan, thanks for being here and take it away.
Hey everybody, Morgan Housel back here again for Phillips and Company to talk today about one of the most important topics in investing, which is what the true price of investing is. Now, everything has a price. And the key to a lot of things in life, especially with money, is just figuring out what that price is and being willing to pay it. The problem in investing, and a lot of things with money, is that the price is not obvious until you've experienced them firsthand. And at that point, the bill is long overdue. Let me give you a little example of what I'm talking about. General Electric used to be the largest company in the world. As recently as the early 2000s, it was worth $1/3 trillion, which made it the largest company in the world at the time. It had either been first or second every year for the previous decade. It was like capitalism's shining example. And then, of course, as you might know, everything kind of fell to pieces. GE today is a fraction of itself. The 2008 financial crisis sent GE's financing division, which at the time supplied more than half the company's profits, into total chaos. It was eventually sold for scraps, and then it had subsequent bets in oil and energy that were disasters, and GE's stock fell about 80%. Total mess. Blame for what went on was placed on its then CEO, Jeff Immelt. He ran the company since 2001. The blame was immediate and it was harsh. And he was criticized for his leadership and his acquisitions that he made, criticized for cutting the dividend, laying off workers, and of course, the plunging stock price, which is really what people cared about. And rightly so. Those who are rewarded with as much compensation as CEOs are have to take the blame and the responsibility when things fall. And so Immelt stepped down as CEO in 2017. But when he stepped down, he said something in an interview that I thought was so insightful while he was on his way out. Responding to the critics who said that his actions were wrong and what he should have done should have been obvious, Immelt told his successor, quote, "Every job looks easy when you're not the one doing it." I love that. Every job looks easy when you're not the one doing it, because the challenges that are faced by somebody who is in the arena, so to speak, are often invisible to those who are in the crowd. And I bring that up because so many of the challenges in investing are not obvious to someone who's just from the outside looking in, learning about it or reading about it in a textbook. You have to really experience it firsthand before you realize what the challenges really are. So many things in life are harder in practice than they are in theory. And sometimes that's because we're overconfident, but more often it's just because we're not good at identifying what the price of success is, which prevents us from being able to pay it. Let me show you what I mean in terms of investing. The S&P 500 increased about 125-fold in the 50 years ending 2023. And to achieve that, all you had to do was sit back and let your money compound. You didn't really have to do much of anything. But of course, successful investing looks easy when you're not the one doing it. If you're just sitting here talking about it and saying, all you had to do was hold stocks, it's easy to say. It's much harder to do when you're actually doing it. You hear people say advice like, hold stocks for the long run. And that's good advice, very good advice. But do you know how hard it is to maintain a long-term outlook when stocks are collapsing? Much harder than it looks. Like everything else worthwhile, successful investing demands a price. But the currency of that price is not dollars and cents. It's volatility and fear and doubt and uncertainty and regret, all of which are very overlooked until you're dealing with them in real time. The inability to recognize that investing has a price can tempt us to try to get something for nothing. And like shoplifting, trying to get something for nothing rarely ends well. I'll show you what I mean. Let's say you want a new car. The car costs $30,000, let's say. You could either pay $30,000 for it, or you can find a cheaper used one, or I guess you could steal it. Now, in this case, 99% of people know that you should avoid the third option because the consequence of stealing a car outweigh the upside. But let's say that you want to earn an 11% annual return in your portfolio over the next 30 years so that you can retire in peace. Does that reward come for free? No, of course not. The world is never that nice. There's always a price tag. There's a bill that must be paid. And in this case, the bill that you have to pay is a never-ending taunt from the market, which gives big returns in some years and can take them away just as fast. That is the price of market returns, dealing with that uncertainty and volatility and unknown. That's the fee. It's the cost of admission, and it can hurt. Now, here's the very important part here. Just like the car, you have a few options when you invest. You can pay that price, accepting the volatility and upheaval, or you can find an asset with less uncertainty and a lower payoff, like cash or bonds or something, or you can attempt the equivalent of Grand Theft Auto, which is trying to get the returns while avoiding the volatility that comes with it. And many people in investing want that third option. Like the car thief, though, like well-meaning and law-abiding form of it, they form tricks and strategies to try to get that return without paying the price. They trade. They buy this and sell that. They try to predict what the market's going to do this year. They attempt to sell before the next recession and to buy before the next boom. Most investors with even a little bit of experience know that volatility is real and it is common. And many of them take what seems like the next logical step, which is trying to avoid it. But the money gods that exist out there do not look highly upon those who seek reward without paying the price. And it is the same thing in investing. Morningstar, the big data company for investing, once looked at the performance of tactical mutual funds, whose strategy is to switch between stocks and bonds at the most opportune times. The strategy is to capture market returns while lowering downside risk. They're trying to get returns without paying the price. And the study focused on the mid-2010s through late 2011 period when the US stock market went wild and fears of a new recession. The S&P declined to more than 20% during this period. This is the exact kind of environment that tactical mutual funds are supposed to work in. This was their moment to shine. And there were, at the time, by Morningstar's account, 112 tactical mutual funds during this period. Only 9 of those 112 had better risk-adjusted returns than just owning a simple index fund of stock and bonds and leaving it alone. Less than a quarter of the tactical funds had smaller maximum drawdowns than just the leave it alone index, a simple, boring, basic index funds. And Morningstar wrote, they summarized all this. They said, quote, "With few exceptions, tactical funds gained less, were more volatile, or were subject to just as much downside risk as just owning a hands-off long-term buy and hold fund." And so look, the question is, why do so many people who are willing to pay the price of cars, they don't want to steal a car, or a house, or food, or vacations, and pay the price for those things, try so hard to avoid paying the price of good investing returns? Why is it so difficult? And I think the answer is actually pretty simple. And that's the price of investing success is not immediately obvious. It's not a price tag that you can see. And so when the bill comes due, it doesn't feel like a fee for getting something good. It feels like a fine for doing something wrong. And while people are generally fine with paying fees, fines are supposed to be avoided. You're supposed to make decisions that preempt and avoid fines, like traffic fines and IRS fines. They mean you did something wrong and that you deserve to be punished. And the natural response for anybody who watches their wealth decline during stock market volatility views that drop as a fine that is to be avoided in the future. And so look, this might sound trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. That is doubly true for new investors who have never experienced a 10% decline. But if you view volatility as a fee, then things start to look different. Going to Disneyland costs $150 to get in the door, whatever the price tag is, but you get an awesome day with your kids that you'll never forget. And so every year, tens of millions of people do it. And few felt that the $150 that they paid was punishment. It's not a fine. It's a worthwhile trade-off. And that is obvious when you're paying that ticket to Disneyland. And I think it's the same in investing, where volatility is almost always a fee and not a fine. Market returns are never free, and they never will be. They demand that you pay a price. And like any other product, you're not forced to pay this fee, just like you're not forced to go to Disneyland. You can go to the local county fair where the tickets might be $10 or stay at home for free. You might still have a good time, but you'll usually get what you pay for. And that's the same with markets. The fee that you pay in markets of dealing with volatility, the price of returns, is the cost of admission to get returns that can be far, far superior to the low-fee parks, so to speak, like cash and bonds. And so the trick is convincing yourself that the market's fee is worth it. That's the only way to properly deal with volatility and uncertainty. Not just putting up with it, but realizing that it's an admission fee that is worth paying. And look, there's no absolute guarantee that it will be. Sometimes you go to Disneyland and it rains, or your favorite ride is closed for the day. But if you view the admission fee as a fine, you're never going to enjoy the magic. So find the price of investing and then pay it.